Let's take a look at problem 11.6, disposals of long-term operating assets. We've got analysis, depreciation, and journal entries, okay? Okay, so we have the information related to the long-term operating assets of Rivera Retail Distributors. And you can see on the table that we've got equipment, machinery, vehicles, leasehold improvements, building, and land. And they've provided us with the cost, the accumulated depreciation through the end of the year 2022, useful life, the estimated residual value, and the method that's being used. And then they give us some other factors. Let me slide up so you can read those. So the fiscal year end of the company is December 31st, and during 2023, I'll slide up a little bit more here so you can see it, Rivera sold the vehicles to wholesale produce for $15,000. That was on February 1st. On March 31st, all the equipment and machinery was destroyed by a fire. And on May 1st, the equipment was replaced at a cost of $625,000, and the machinery cost the company $420,000 to replace it. The estimated useful lives and residual value remain the same as specified for the original equipment. All right, and they paid cash for the new assets. And then we've got two things to do. We have to prepare the journal entries required to record each of these events and record the depreciation expense at the end of the year, and then B, determine the ending net book value of their long-term operating assets as of December 31st on the balance sheet. Okay, and we'll show it in detail and in total. Okay, so let's focus on the vehicle, right? $127,900, accumulated depreciation of $75,000, estimated residual value $2,900, 5-year life, and they're using the straight line method. And we sell the vehicle to Rivera for $15,000. So let's focus on that. Let me put this on the screen so you can see what we're going to do. Let me slide so we have some the vehicle in front of us. There we go. Okay, so what do we have to do? Look down here. $127,900, that was the cost given by that value there, less the $2,900, the residual value divided by 5. So the annual depreciation was $25,000 per year, but we only had 1 month of the year that it was taken, right? Because we sold it on, I believe, let me slide this up, on February 1st. Yep. Okay. So if we sold it February 1st, we're only going to record 1/12 of depreciation. So that's $2,083. So to record that depreciation expense, we debit depreciation expense for vehicles, right? And we credit accumulated depreciation. Okay, so we get $15,000 for the cash. Now at this point, our total accumulated depreciation is $77,083. That's the $75,000 that we already had plus the depreciation we just took, $2,083. So we need to debit accumulated depreciation to get it off our books. We need to take the cost of the vehicles off our books as well, $127,000. And then the difference represents a loss, since essentially the cash we received is less than the book value. Book value would be vehicles less the accumulated depreciation. The difference results in a loss. If we received more cash than the book value, we would have had a gain. Okay, now let's focus on event number 2. March 31st, the equipment and machinery was destroyed by a fire. All right, so I've put the journal entry in front of you. Now, we've got to depreciate from January 1st to March 31st on the equipment because it was in use during that period, right? So they were using the double declining balance, which is cost less accumulated depreciation, gives you the net book value. Double declining balance with a 10-year life would be 110 times 2, 1 divided by 10, 10% times 2, or 20%. That's where that comes from. So when we do that math, we get 64,000, and 3 out of 12 months, January through March, gives us 16,000. So we're going to record 16,000 of equipment. Then we need to know what's the book value at that point. right? So we take the accumulated depreciation plus what we just added in depreciation expense, figure out that's the total amount of accumulated depreciation. The cost was, where's our cost value here? 10,625. Oh, that's I'm sorry, we've got to take the depreciation expense on the equipment and the machinery separately. So there's the 16,000, and then we do the same type of calculation for the 10,000. Okay, I was trying to get through the next part here, but we've got to record depreciation for 1/4 of the year for both the machinery and equipment. Then you calculate what the machinery cost was. There's the 345 right there. Right, if I slide down, the equipment was 500,000, right, and then we debit the accumulated depreciation to take it off the books. And since we get nothing for it because it's worth nothing as a result of a fire, whatever the book value is becomes a loss. We lost the value on that. So we record the difference as a loss on machinery and a loss on equipment. All right, then we move on to May 1st. On May 1st, the equipment was replaced at a cost of $625. And let's see, $625 was the equipment and the machinery was $420,000. Okay, so if I slide that over, you'll see that what our entry is simply debit equipment and machinery for $625 and $420 respectively. We paid cash for it, so we would credit cash. Okay, and then we need to record depreciation on the remaining items, right? So we've got building equipment, machinery. So if I slide that up, we should be able to see our various ways of solving. Okay, now I've got most of the explanation on the screen now. Okay, so the building was just simply using the new method, 12 million minus $1.5 million for 20 years. So we're going to record 525,000 for the building. Now, the equipment was only for a 8-month period, right? The building, there was no harm to the building, so we record a full year's depreciation. For the equipment, though, we've got a partial year approach. We've got to only record depreciation for partial year. So now we take the cost minus accumulated depreciation. The first year accumulated depreciation is 0, so it's 625,000 times 20%, but we can only take 8/12 of that. So we've got 83,333 to record as depreciation expense on the equipment. Okay, machinery, we're doing the exact same approach. Except that we're using the straight line method. So the straight line method, we need to take the cost less the accumulated depreciation divided by an 8-year life, okay? And then take 8/12 of that. So that's where the 34,000 comes into play. And then finally, leasehold improvements with straight line method, 65,400 divided by 3 years is 21,800. And that's how we come up with the journal entries for depreciation for the remaining period of the year. In some cases, the full year. Okay, and now we'll deal with part B, which says determine the ending net book value of Rivera's long-term operating assets. And here you see the solution here. Now, how do we come up with this? Well, you've got to do the math, right? You've got to figure out what was the cost recorded on the books, what did you add to the depreciation by taking, by debiting depreciation expense and crediting accumulated depreciation, or what did you reduce because we sold assets, right? You probably want to run T accounts or use T accounts to figure out what your balance is, okay, or what your balances are since we've got more than one account. So we've got the various costs. We know what the beginning book value was. We know what the current depreciation is because we recorded all of that, and therefore we can also determine the ending accumulated depreciation. But keep in mind, in some instances, we reduced accumulated depreciation because we either lost the asset or we sold the asset. Okay, so hopefully you found this helpful. And be sure to pause the video at any point if you thought I went a little bit too fast and you want to go back and follow through. It may even make sense for you to work these problems either in Excel or paper and pencil as you go through this and make sure you can come up with these numbers.